Price action trading hasn't been easy, and it did not click for me for many years, not because it was hard, not difficult, but because there was nobody to explain it for me in the right order. My name is Ojung Joseph, and I've been trading the financial market for nearly 6 years. I am the founder of Likeman FX Trading Academy. My goal is to make you a successful trader by simplifying price action trading to you as much as possible. Now that you know who I am, let's focus on the 3 steps that finally made price action simple, precise, and profitable for me. To be honest with you guys, when I first started trading, I consumed every information out there about price action trading, and I saw that the pro traders drawing a bunch of stuffs on their charts. So they were drawing a bunch of stuffs on the chart. So that left me confused, and that left me frustrated because it was difficult for me to actually understand. Left alone, they also asked us to memorize a lot of candlestick patterns, bullish engulfing, pin bar, the hammer, and a bunch of other nonsense. Most of it all, it was too overwhelming, too many patterns, too many rules. Secondly, I identified the pin bar candle, but I realized that I still lost money. Not because I did not know how to read the candlestick patterns, but because there was no context, right candlestick, the wrong place. So what I have realized out over time is that majority of traders don't lose money because they can't read candlestick. They lose money because they are reading them without proper understanding of the context. That means that even if you don't understand the overall picture why price move the way it does, it doesn't matter if you have the perfect setup or the right candlestick pattern, your strategy will still fail. It's kind of funny how everyone wants to teach price action as though it was just a dictionary that they just can hand over it to you with rules and ask you to follow without giving you the proper understanding of why the market moves the way it does. The truth is that the market does not move like that. It moves like a story, which also means that if you skip to the last chapter, nothing will really make sense because you are trading without context. Where you don't understand the reality of the market itself, you just project your own perception and your own intuition into the market. So that is when I stopped chasing random candlesticks or chart pattern, and I reduce everything to just 3 simple steps, which I'll be showing you right now. And if you follow the 3 steps in order, I can 100% guarantee that price action trading will become extremely boring, methodological, systematic, and mechanical. But you become extremely profitable, because profitability in trading comes from doing boring stuff and repetitive stuff over a prolonged period of time. So basically the 3 steps that you'll be following are direction, location, and execution. So let's go through them step by step. So starting with direction, the first question that comes to mind is who is in control of the market? So buyers or sellers. And if buyers are in control of the market, you look for longs. And if sellers are in control of the market, you look for short. You always do this on the higher time frame of the market to identify the direction of the market. You identify the most recent break of structure. Okay, so right here you can see that this market is bullish. Okay, so therefore you're going to be looking for what? For buys. All right, so now let's identify our most recent break of structure and then identify our swing points. All right, so here is our most recent break of structure. You can see it there, right there. All right, so that's our most recent break of structure. Okay, so that being our most recent break of structure. All right, now you want to pick your swing highs and your swing lows so that you'll be able to focus on a particular area. You don't just leave everything open, you understand, so that you know exactly where you want to buy. You get. So now the next step after identifying our swing highs and our swing lows, now this is our swing low, okay, and this is our swing high. All right, now I'm assuming that the market has not actually come to this area, okay, before it's moving. So I've not actually subscribed for my trading view because I'm having issues paying for it with my card. So you just bear with me. Just bear with me for a while, then I'll sort that out. So now we are assuming the market does not actually come to this area. So we have picked our swing high and our swing lows. So and we have actually identified the most recent break of structure. The next step is to identify the location where we want to actually be buying from. So to do that, we use our Fibonacci tool from this our swing low to our swing high. You get? So we want the market to come to the discounted area. Okay, we have the premium price, which is too high, and we have the discounted price, which is the good area where we want to actually be buying from. Okay, so you wait for the market to come to the discount, all right, before you actually take your buys. So now I'm just going to remove these candles from my chart, and then I'm going to mark this demand zone right here. All right, I don't want to be trading price action in the middle of nowhere. Why? Because if you do that, let's say you open your chart and you just decide to jump and buy, what happened? You end up losing money and your risk reward ratio is so going to be poor. So it's better for you to map out your premium and the discount and then choose to wait for the discounted price so that you buy from there and you have the good risk to reward ratio. So to also identify your exact location, you use the premium and discount like I said, and you mark out your POI. Your POI stands for your point of interest. So right here is our point of interest. This is the area you want to be buying from. So now we scale down to the 1 hour time frame and look at what the market is actually doing on the 1 hour time frame. Okay, you can also redefine the whole of this stuff right on the smaller time frame. On the 1 hour time frame, you can redefine your POI. Okay, reason being that you want to make it the best location as much as possible because you want precision, and precision will help you give you a good risk to reward ratio. Okay, so now when the market gets here, you don't really want to buy like that. You understand? You don't want to buy, and that is going to bring us to the last stage, which is our execution phase. Okay, so the last phase, which is our execution phase. Now you see there's a break of structure. We have our demand zone right here. Okay, so now let's look at this area right here. We're going to scale down to the 30 minutes time frame, possibly also the 15 minutes time frame. You can see here that there is a good rejection candle. Okay, you want also confluence. Confluence gives you a good reason for you to want to buy, and you want to actually identify a strong rejection candle. Okay, now like I said earlier, you understand, when they ask you to use a candlestick, there was no confluence to it. You understand? So this is the right way to actually use those candlestick pattern, not just using candlesticks in the middle of nowhere. You understand? So right here you can actually see that there is what a confluence right here. So even if you enter right here like this now, you'll be profitable. It will make sense. Why? Because you have actually been able to narrow it down. Your stop loss can just be there, and then your target, you're still making a good risk to reward ratio. Okay, 1:6. But now let me tell you, I want to show you how to actually get a better risk to reward ratio and to increase the probability of your trade. So now we scale down to the 15 minutes time frame, okay, to actually be able to get a better entry. Okay, and then now look at this. Okay, now what happened here is you have actually identified that there's a market structure shift. Okay, there's a market structure shift. All right, even though the market has not actually come to this area, sometimes you can wait. You can wait for the market to actually come back to, let's say, a breaker block. All right, let me zoom in a little bit so that you can clearly see. All right, you can wait for the market to actually come back to a breaker block. Sorry, fair value gap, not breaker block. Breaker block is actually different. You understand? But it can still work in this particular case. You want, sometimes after the market structure shifts, okay, you want the market to actually trade back into this fair value gap. You understand? So you want the market to trade into this particular area. Okay, you want the market to trade into here before it moves to the upside. All right, so but not, it doesn't always happen all the time. So I'll give you how the ammunition to use for continuation pattern. Okay, like that. So right here you can clearly see, let me zoom in a little bit. So now there's a market structure shift. Okay, there was no pullback to a fair value gap. Now we also know as the market moves, it also continues to create fair value gaps. All right, so right here you can clearly see how the market traded into this fair value gap, and then what happened, you can just simply enter rather than risking a $58. Okay, we can just reduce this to 24 or even maybe less. Okay, so you can make it less. All right, so maybe 21 and so on. Then you still have you can still head to your target. Okay, so now rather than keeping our target at 1:6, now you're having 1:13. You have actually been able to increase your risk to reward ratio. And there is another area right here which I actually entered because I missed this particular one. So right here you can see the same fair value gap. Okay, so as the market entered, it traded into the fair value gap. All right, like I said earlier, like I explained using this particular area here, you can clearly see that there is a break of structure, not a market structure shift. A market structure shift happens when there is a change of character, like there's a change in market trend from bearish to bullish. Okay, break of market structure is more or less, it happens in the new trend of the market. So in this particular case, we have a break of structure which we have right here. So now you see what happened, almost similar to what I was anticipating here. Okay, so the market traded into this area. All right, so what happened, you have your stop loss, you can even use premium and discount right here. It will still be at the discounts, so you can see. All right, so the market traded into the discounted area. Okay, you see that. So it's just simple knowledge of price action. You understand? So now your stop loss just slightly below. You understand? Now I was risking about, probably if I'm using 0.1, I'm risking about $11 to make about $259, which is 1:21 risk to reward ratio. Can you imagine that? So it's just simple, guys. It's just very, very simple. And even if you are looking for a continuation, you can still do that in between, like in between. Just, you know where the market is headed. Like, let's say that is the target, you can still look for continuation. Like, let's look at this area here. You understand? You see that market traded into there, you get, and now it just kissed into that area and then it's heading all the way up. Why? First, you can clearly see that there is a pullback right here into this area right here, and then there is a break right there. Okay, so there's a break of structure right there which is internal, right? So now I can also scale down this to the 5 minutes time frame so that I can actually get clarity there. All right, so this strategy works very, very well for gold. Okay, so right here you can also see that there's a fair value gap right here. So you see here there's a fair value gap. Let me just mark it very well, but it's kind of very tiny, guys. It's kind of very tiny. So you see the market traded into that area, but one thing you should note is it did not take out this low. Okay, so that's why I always love to put my stop loss below. Okay, so now let's go back to the 15 minutes time frame. That's why I love to always keep my stop loss below the low here. So you see, now let's say you entered here, this one would have had a big stop loss. Yep, so I've had a big stop loss, 1:13, $13 stop loss. You see, you estimate your 1:4.8. You understand? Looking at that, so this strategy is very, very simple. Anybody can actually apply this. You understand? So don't forget to hit the like button and then continue to watch our videos and share our videos to as many persons as possible. I remain your one and only Ojin Joseph, the price action trader and the founder of Like Mind FX Trading Academy. So stay blessed, fam.